For all stats in this episode, please see the description for their sources.
The Financial Huddle does not provide tax, legal, financial, or other professional advice. Listeners are encouraged to consult with their own advisors in these areas.
All right, everybody, huddle up. Play calls in. This is the Financial Huddle. Ready? Break.
Hello, everybody. Welcome back to the Financial Huddle. Huddlers, we're so glad that you took some time to join us today. As always, I am joined by my two compadres, Ed B. Miller.
Hello, hello.
Brian Fleming.
What's going on, everybody? What's up, B?
How's everybody doing?
Doing awesome.
Good.
I woke up this morning. It's a beautiful day.
Yeah.
Right?
Glad to be back. Another
you're above-
episode.
When you're above ground, it's a good day.
There
right?
you go. There you go.
Hope you guys are doing good too, huddlers.
That's right. So we are going to continue into part 2 of that 2-word curse words, I should say, that we talked about last time.
What's that?
Going to talk about life insurance.
Oh,
right.
yeah.
A little bit polarizing out there. And hopefully, if you have not had a chance to listen or watch that, we want to encourage you to go and do that. A lot of really good information where we talked about, is cash value life insurance a viable asset? And obviously, we feel that
Right.
it's a very important part of your financial outlay.
Yeah, and this one, is what we talked about the last time is let's dig into the weeds a little bit on what are the living benefits
Yep, I love that.
of this asset class, right?
That's really what it is.
And we talked about, you talked about, it's a now asset. It's not a then asset or wait asset.
Yeah, using these benefits while you're alive.
Yep.
And we talked a little bit about how it's not a comparable or a competing asset to an investment, but it works in conjunction and it works together. So I thought what I would do is I want to tell a real life story about a really close personal friend of mine who is also a client. And this person likes to flip homes. Very good at it, very handy. And he's got multiple financial strategies with me. And he called me one time and said, Brian, I need some capital. And I'm thinking about going into my Roth IRAs to get some capital because I know from a tax perspective, I can get my cost basis without any taxes or penalties. Mm-hmm. And I said, you have these cash value life insurance policies that you can access, take a loan against the policy, use that, not have any uninterrupted growth. And then when you sell the home after you flip it, pay that back into the policy, and it's if you've never taken a dollar out of that policy.
The light bulb went off, didn't it?
The light bulb went off, and sure enough, the next day, got some information. I need X amount from my policy.
Yeah,
we were
smart
able
man.
to do, and I said, guess what? You can continue to do this as you continue to flip homes.
Yeah.
So light bulb went off. It's going to work very well for him, and he's able to do this because of how we created this policies. And I know you talk a lot about this. What is really important when we are designing the policies?
Yeah. So the first thing that we need to identify as advisors is ask the question, what's your objective? What are you looking for? And we talked about in the last episode, is the focus or objective death benefit, i.e. legacy value, or is it wealth accumulation? And most of the people we talk to, we feel there's definitely a role for or a need for that wealth accumulation aspect. So getting back to how is it structured? First and foremost, because there's a lot of people out there that sell life insurance, right? A ton.
There's a lot.
98% of those have no idea how to truly efficiently design a high cash value insurance policy. I don't know how many people, and we all have come across where they're like, oh yeah, I have that. Oh, can I take a look at your policy? No, you don't have this. You have a policy that, yeah, it's building some cash value over the next, 10, 15, 20 years, but let me show you how we design those policies. So working with someone that understands how to design and structure these, but not only how to design them up front. What's just as important is how do I utilize them moving forward? So the structure of these plans and what we talk about, the value of a traditional plan is all based upon what they're trying to achieve is a certain level of death benefit. So they're trying to maximize the death benefit. When we're looking at this from a wealth accumulation vehicle, we're looking to maximize the cash value and wealth accumulation and to minimize that associated cost. So there's a certain level of cost that you can avoid because it is defined as a life insurance plan by the IRS and tax code, and we went over a little bit of that in the first episode with that. But it's extremely important that it's designed to maximize that cash value.
Yeah.
That is, and what I like to call the icing on top of the cake is that legacy value, because we always make these statements. You can't take it with you, right? So what's the best form of wealth that you could pass on to your beneficiaries? Well, tax-free wealth.
Tax-free. That's right.
So hands down, I don't care what type of life insurance you're using, term insurance, index universal life, whole life, all these different types of insurance out there, universal life. The death benefit is tax-free. So hands down, best legacy vehicle and strategy out there. And I think
but if
we
it's
would all
not
agree to that.
good.
if it's not structured correctly, it's not going to do what we need it to do.
Yeah.
And a lot of advisors and agents, they don't structure it right.
And they don't structure it right because they don't know how to.
Correct.
Either they don't structure it right from a tax perspective, or they build it in a way that's not as efficient and
Correct.
cash rich as
Correct.
we would hope that it would.
Yeah. And it's all about controlling and minimizing the cost, staying within, Ryan, you say it all the time, kind of staying within those ratios, because that tax code is going to evaluate each of those plans and say, listen, you got to have a certain level of death benefit, and so much.
Yeah, and what do we call
to
that,
support
right?
that.
So I think the huddlers would appreciate, right? So what do we call it as a maximally efficient contract, right? It's got to pass the MEC.
Well, it's got to pass, yeah.
Right? The
Yep.
modified endowment contract.
So
Yep.
we want a non-MEC.
We want a non-MEC. We
Yeah.
want to make it as rich as possible, but stay underneath
Yeah.
that IRS
And,
line.
and what that non-MEC means for we're introducing this concept to a lot of people is that the account will grow tax-free. It's liquid and accessible, that you can access and utilize it. I'm going to talk about that in the next point, a little bit more about that.
Yeah.
For the most part, it is a protected asset. It's protected from all lien holder and creditor rights. In most cases, it's even protected from a personal bankruptcy.
Yeah, and there's no tax on gain if
Correct.
it's done right? No
Correct.
1099s.
Right.
Yeah.
And then ultimately it can be utilized throughout your lifetime. And then when you do, so it's a lifetime while you work asset. It can be a retirement, complementary income, capital reserve. There's so many different ways. You've heard a lot where it's like the Swiss Army knife of financial planning vehicles, and you don't have to determine today how you're going to utilize it in the future.
Now, I've heard people say that everything that you buy in life, you finance it. Whether you buy a candy bar or you're buying a college education, everything that you buy in life, you finance it.
Yep.
So maybe speak to our listeners out there. How do we use it as to control the banking function of our life?
Yeah. So a big part of this, if you've heard different names thrown around for, this cash value life insurance, bank on yourself, infinite banking, wealth beyond Wall Street. Also, a common acronym is what you use, Ryan, a lot. We use is ALERT.
Yeah. A life insurance retirement plan.
There you go.
Yep.
So one of the significant advantages of this, and this gets back into the concept of banking, is that you can actually use this as your liquid accessible source of capital. And you're able to borrow against the value in that plan. So i.e. leverage it. Borrow from that asset without interrupting continuous growth. And not to get way too far in the weeds, but effectively, when you're borrowing against this type of plan, you're borrowing against the value from the value. So the growth within the plan continues at 100% whether you borrow or not.
Yeah.
So it's a very unique feature. And then on top of that, you brought up your example of someone involved in real estate. And that, I'm assuming that's more of a side hustle for him, or is that what he does for his
It's
his
side
job?
hustle.
Yeah. So listen, whether it's a side hustle or whether that's what you do, investment real estate, they need access to capital. The best thing about it, in the example that you brought up, what if you had the ability, and I'm sure this is what he's doing, he can borrow against that policy. he's both the bank and the borrower because effectively it's his asset. And then because he's flipping it, it's going to take whatever, a month, 2 months, 3 months to do the rehab, reconstruction. You don't have to make any payments during that period of time.
That's right.
And then he puts the house back on sale and then uses the proceeds to pay off the loan plus whatever interest that accrued. But during that time, there's no carrying costs for him.
That's right. And if he would have taken the money from the Roth and whatever he would have taken out, he would have had to put that money back within 60 days, or guess what? He can't put it back.
Correct.
And so he just lost all of the growth and the future growth of that asset.
And the other thing I might add to that is when you have a loan against your life insurance policy, you could say that that's the best loan position ever to be in because it's a non-recourse loan, which means that if he does, let's say he unfortunately died during that process. He took the loan against it. He bought the rental property. He passed away. Well, he didn't pay it back, right? But somebody will.
That's right.
The insurance company will pay it back because it's just collateral against that death benefit. They'll pay that back, and then his family gets the net proceeds completely income tax free, right? If you don't pay back the mortgage on your house, what happens? If you don't pay back the mortgage on your car, what happens, right? They're going to take it from you.
I just say bad stuff.
Bad stuff, man. So that loan position is very, very favorable. And again, technically, it's called a non-recourse loan. If you don't pay it back, somebody else will. The insurance company will.
And one more thing on that, talking about the loan, and as someone that was a commercial lender for 17 years, this is something that most people don't know and maybe don't really truly understand. The loan is a simple interest loan as opposed to an amortizing loan.
Huge.
So what that means,
Big deal.
a lot of people probably don't even understand what that is. Simple interest loans almost don't exist anymore.
Yep.
And the reason being is a simple interest loan is designed so that every payment you make goes 100% to principal. So
you're only paying interest on what's left,
correct.
right?
So
That's great.
that interest is significantly less than in, let's use an example, a typical mortgage or a car loan, an amortizing loan, where in the beginning, probably 90% of your monthly payment is going towards interest carry.
Yeah.
That's right.
So a simple interest loan is by far the best type of loan you can get because it basically minimizes, relatively speaking, that interest accrual and interest expense over the period of the loan, which means you're going to pay significantly less in interest.
Such a big deal. 'Cause
Yes,
a lot of times
it
people
is.
are like, "What's the rate? And what's the rate of this?" And but your description, it makes a big deal.
Yeah.
And you're paying a lot less in interest
Yep.
than you would have.
Yep.
Right.
And
On an ordinary loan.
Yeah, a lot of people don't really understand. There's a lot of very unique features that come with today's policies. And I know, Ryan, something that you talk a lot about, which I'll kind of throw it over to you, is, what's another feature, unique feature?
So we talked about the importance of the structure, and we talked about how to utilize it as a banking source to be your own source of financing, because we finance everything that we do in our life. But there's two really, really important ones. I think all three would agree. These are massively important when it comes to income and distribution planning and estate planning. And over the past several years, relative to this topic that's a very big buzz topic in our culture, long-term care. Long-term care can decimate a lifetime of portfolio growth and savings. It's a insidious risk that faces millions of people as the baby boom generation gets older, and it's just really, really expensive to consider. And so, if you don't have a plan to pay for long-term care, your money is your plan, right, fellas?
That's right.
And
Yeah,
so
you're self-insured.
yeah, I mean, so your plan is your money,
Yeah.
right?
Ruh-roh.
Well, over the past several years, you could quell that potential risk by purchasing a traditional long-term care policy. And that's a different discussion for a different day, but those have kind of fallen out of favor. And what a lot of people don't understand is that by purchasing certain types of cash value life insurance contracts, there's a rider that comes along with the contract that there's no premium that's needed to be paid for. It's called an accelerated death benefit rider. And what that means is if you couldn't perform 2 out of the 6 activities of daily living, and you could get a doctor that would write a letter stating that, then you have the potential to have some of that death benefit fast forwarded to you over a period of, let's say, 4 years. And typically, it's right around maybe 25% of the death benefit that can be fast forwarded to you. Again,
While you're living.
The living benefits of life insurance to address those insidious risks like an assisted living or, God forbid, a terminal illness or a memory care type of a situation. And that is arguably maybe one of the most important reasons to consider opening up one of these policies, is that there's a 70% chance that a spouse today, if you're married today, there's a 70% chance that one of you or your spouse is going to experience some kind of long-term care event. So having that right along with the policy is massively important.
It's huge. I can tell you, when I first started in this industry and long-term care would come up, I was just, yeah, okay. I don't see it. I don't think it's ever going to happen. And I can firsthand speak to, it's something that we're dealing with in our family. So it happens way more than you think, and it is something to prepare for. And these policies, having that rider, it's a big deal.
It's a game changer. And again, I think it's one of the most, if not the most important reason to consider a policy. Because I mean, at the end of the day, if you pass away in your sleep, never needing long-term care, and somebody's getting that death benefit tax-free. Right. If you do get sick, okay, then you have that ability to turn on that long-term care help source. Or if you live to 100 years old, you can access the capital to live. So you should never get the sensation that all the premiums you put into the policy, you're not going to get something, right? So that's important. All right. So $1 into a life insurance policy gets us three things. It gets us a death benefit that passes to our heirs. It gets us a potential long-term care help source. And it gets us potential tax-free access to capital all throughout our life without the interruption of compound interest. The next thing that I think is important from a retirement income and distribution standpoint is that this serves as a phenomenal volatility buffer, an absolute awesome antithesis to bonds, if you will. So one of the things that we tell our clients, one of the things I preach a lot, and I know you guys do too, is that the day you retire, you may want to consider trying to have 3 to 5 years of your retirement income needs saved up in cash value inside a life insurance contract structured properly. So if you need to retire on $100,000 a year, we would like to see somewhere between $300,000 to $500,000 of cash value the day that you retire, because when you go to pull money out of accounts and the market's down, okay, instead of pulling it out of your equities, you could pull it from your life insurance policy, because these policies are not correlated to the stock market. It's a non-correlated asset. And that allows your equities to rebound and can lengthen the sustainable withdrawal rate on those equities. So it serves as a wonderful volatility buffer in that way.
Yeah.
Okay.
Or with the flexibility, when those equities do come back, and maybe even grow a little more, you could take some of the chips off the table, pay back your high cash value insurance policy just to kind of re-up the availability on that. Right. So there's so many different things you can do. A lot of
options.
Or maybe you get an inheritance late in life. You need somewhere to put it, right? So, so long-term care supplement and a volatility buffer are another amazing living benefits that many people don't understand, but they should.
Yeah.
That's right.
Yep.
And then I think finally, we've talked about this quite a bit, this is a vehicle that if you structure it properly, to your point, it is a tax-free source of additional income. Now, I always ask my classes when I teach them, what is the number one expense you're going to have in retirement? People think it's medical. It's not. It's taxes.
It's taxation.
It's not even close. Taxes is by far the biggest expense. So if you can have sources that you can utilize that you don't owe taxes, that's huge. Now, here's the other thing, too, that a lot of people don't realize. Not only does it impact what taxes you pay by determining where you're pulling the money from, it also impacts your Social Security benefits. So there are two main sources that are not included in the provisional income as it pertains to Social Security, and they are Roth IRAs, cash value life insurance.
Right.
So as you pull a distribution, whether it's a loan or a withdrawal, a partial withdrawal, it does not include it in the provisional
It's not taxable income.
That's right. And so it's not included in that.
And I'll add one other thing. There's no required minimum distributions on cash value life
Yep.
insurance. There's no RMDs. So there's no tax bomb down the road if taxes double.
And nor is there, especially from legacy or intergenerational wealth transfer, passing this asset, obviously the high cash value life insurance, death benefit tax-free, but you talked about Roths, getting the money into those tax advantage accounts really can go a long way, as far as legacy
we have this
planning
conversation
and passing
all the
assets
time.
on.
A lot of our clients, they hate to see the balances in their IRAs go down. And I always tell them, do your kids want that IRA balance? or would they rather have life insurance? It's
Yeah.
not even close.
Yeah.
Well, yeah.
Yeah.
Cash, tax-free,
Tax-free
versus
versus
a 10. I got to spend this all down in 10 years
Which
and
is
pay
gonna
my
bump
taxes.
me into the next tax
Right.
bracket, and I
Yeah.
got to pay ordinary income tax.
Right. You don't want to do that.
So-
and where do you want to be if you just look at the tax environment? Most talking heads, most people believe taxes are going up.
That's what I was
So-
going to say. Yeah, and this is one of 6 different tax-free streams of income that we can create. It's not the only one,
Right.
But like I said earlier, it gets treated different than any other thing in a tax code. It's a viable option. It's a hedge against higher taxes and everything that we talked about today. Right.
Yep.
So
Well, good information, and I hope as you're listening or watching that you realize that these dirty words were not so dirty. They were actually
that's right.
I think helpful. So it is a great piece of your overall financial outlay. If you have questions on how to implement one of these or how this could work for you, please
or just
reach
want
out.
more information about it.
So we're glad to give that to you. So as always, huddlers, we really appreciate your time. And if you have things that you want to hear about or want us to talk about, please send those. We would love to bring those up in our next episodes.
Yes, sir.
With that, thank you for your time. Have a great day. We'll see you next time.
Like, follow, and subscribe. See you guys.
See you next time.